Hi everyone, today we are going to solve A-Level Accounting Specimen Paper 2023, Paper 4, question number 2. So here, this is the insert of the question number 2. So it's B for question 2 and this is the question paper. In examination, you will get asked two papers. One paper insert, the another one is question paper. Here I have combined for solution purpose. So here let's see. Z Limited received an order from an existing customer to manufacture new product for a period of 4 years. To satisfy this order, the directors of Z Limited have to purchase a machine from overseas with an expected cost of 300,000. The machine has useful life, 4 years is the expected life, no residual value. Hire a specialized engineer. They need a specialized engineer to run the machine. Purchase direct material from a new supplier. Next, the estimate relating to the operation of this are, they are given the cash inflow and cash outflow and with the years. The cost of capital is 10%. The relevant discount factors are, they have given 10% and 12%. Discount factors also given. It will help us to calculate the net present value, right? Yeah, let's move. So, question number 1. Question number 2A. The first one. Calculate the payback period in years and days. The payback period in years and days, the equation is the payback period is equal to years before full recovery plus unrecovered cost at start of the year divided by net cash flow during the full recovery multiply 365. So first we have to check the years before recovery. For that, first we have to prepare the net cash flow statement. So we do the cash flow statement first. Cash flow statement. How many years we have total? Total years are 4. Here they are given years, cash inflow, cash outflow. So cash inflow minus cash outflow is equal to net cash flow. So first we have to do year 1, 2, 3, 4 cash inflow minus cash outflow. So that we can do first. First we have year 1, 2, 3 and 4. Year 1 cash inflow, they are given in the question. 1, 2, 3, 4. Cash inflow 200,000. $230,000, 240,000, 210,000. They are given in the question, right? Next, cash outflow 140,000. Cash inflow minus cash outflow 140,000, 130. All the cash outflow we deduct. 110,000 and 100,000. So net cash inflow is equal to cash inflow minus cash outflow is equal to our net cash flow. So we can do the net cash flow. First year 60,000. Second year 100,000. 1000. Third 240 minus 110. That is 130,000 and 110,000. So the total is, what is the total? 400,000 is the net cash flow. So we can apply to the equation. The first one, years before full recovery. How much we have to recover? We have to recover the cost. What was the cost of the machinery? Cost of the machinery has given 300,000. So we have to recover this 300,000. So let's see when we can recover the 300,000. Here, year 1, 60,000 plus 100,000, 160,000 plus 130,000, 290,000. But we have to recover 300,000. So the years before the recovery, next year is 110. So we can take the 10,000 from the fourth year. So the 3 years net, the year before recovering the cost is 3 years, year 3. Year 3 we have total is 290,000. So year 3 purchase of full, the payback period is equal to 3 plus year of recovery is equal to 3 plus unrecorded cost at start of the year. Here 300,000 is the machine value, but this is 290,000. This come 290,000. So 300,000 minus 290,000. 300,000 minus 290,000 is equal to 10,000 we have to recover. So unrecovered cost at the start of the year. Unrecovered cost at the start of the year is 10,000 divided by net cash flow during the full recovery. Net cash flow during the full recovery is, full recovery we can do in the fourth year. 110,000 is the full recovery net cash flow. So divided by 110,000 multiply 365 is equal to 3 plus 34 days. 34 days is equal to 3 years 34 days. This is the answer, 3 years and 34 days. Next question. Question number 2. Calculate the accounting rate of return to 2 decimal places. So accounting rate of return ARR is equal to average profit divided by average investment into 100. So we have to check the average profit. How much was our profit? Average profit is divided by average cost. So the average profit is 400,000. 400,000 divided by 2. Our profit is 400,000 is the profit. So average profit divided by average investment. So we have to find first the average profit. Average profit is equal to 400,000 divided by number of years are 4 is equal to 100,000. 400,000 average profit is the total net cash flow minus 300,000 average profit. This is our net cash flow. So minus net cash flow minus our cost 300,000 divided by 4 is equal to 25,000. This is our average profit. Next, average investment. Average investment is 300,000, right? 300,000 is the machine value divided by 2. Average will take with 2. 150,000. So we have to just apply into the equation 130,000 average profit divided by average investment. Average profit is 25,000. Average investment is 150,000. So is equal to 25,000 divided by 150,000 is equal to 16.67%. So average rate of return done. Next, calculate the net present value. Net present value we have to calculate. So here they are said in the question, they are given two factors, but the cost of capital they are calculate the cost of capital they are given the rate is 10%. So we have to find the net present value at 10% is the net present value we have to find. So net cash flow multiply 10,000. We have to take net cash flow multiply 10,000. So the first one to calculate net present value, we have to do here year. The first year we have to find 0. 0 year we put because the year when we are doing the investment, we are invested 300,000 cash paid. This net cash flow means paid. That is the year 1. So we multiply with 1 is equal to minus 300,000. So the first year we done. Next, how many years we have? We are having 4 years, right? So 1, 2, 3, 4. The 4 years net cash flow we take. Not outflow, not inflow. Net cash flow. Net cash flow already we are done here. Cash inflow minus cash outflow. This one we are going to take. This is the amount we are going to take. 60,000, 100,000, 130,000 and 110,000. This is our net cash flow. We are done in 2A1. Net cash flow we are done. So each net cash flow we write here. Net cash flow. Each net cash flow is 60,000, 100,000. We are already calculated there, right? 60,000, 100,000, 130,000, 110,000. So we have done the net cash flow. Next we have to multiply the 10% factor value of 4 years. 4 years 10% factor value. Discount factor they are given here. Year 1, 2, 3, 4. So this we have to multiply with year 1, 2, 3, 4. So the factor value multiply. The factor value is multiply the factor value. Each one we multiply. 0.909, 0.826, 0.751. Each year the value will decrease, right? 83 is equal to. So what is the amount? The amount is 300,000 plus each one the multiplication 54,540, 82,600, then 97,630, 75,130. So the total amount, the total of this minus 300,000 plus 54,540, then the total is coming, the positive value 9,900 is the total net present value, NPV. Net present value is 9,900. Next, calculate the internal rate of return. Calculate the internal rate of return at 2 decimal places. So the internal rate of return is equal to lower discounting rate, that is lower discounting rate plus net present value at lower discount rate multiply higher discount rate minus lower discount rate divided by net present value at lower discount rate plus net present value at higher discount rate. So we have already calculated the net present value at lower discount rate, that is 10%. We are already calculated here, that is 9,900. Right. Next we have to find the higher discount rate net present value. Higher discount rate is, what is the percentage? The higher discount rate is 12%. So 12% net present value. The same method what we follow to calculate the net present value in question number 2A3, the same, but only what change, the net present value is the discount factor change from 10 to 12. So we can do year net cash flow 12% net present value. So how to find? First we have to do the year 0. So the first one, year 0, that means our investment 300,000. Then the 0 here we just multiply with 1 because that is our investment, the current value. Next year 1, 2, 3, 4. We can do fast. 1, 2, 3, 4. 1, 2, 3, 4. Net cash flow already we calculated, the same what we did in the third one, net cash flow, but only the discounting factor will change. We will multiply with the 12% discounting factor. So the net cash flow is 60,000, 100,000, 130,000, 110,000. So 12% discount factor has given here. The 12% discount factor we have to take year 1, 2, 3, 4 discounting factor at 12%. 12% discounting factor is 0.893. It will decrease again. 0.797, 0.712, 0.636. So we have to just find the equal to value. The value is 53,580, 79,700, 92,560, 69,960. Then the total is, we are getting the total amount is negative value, that is 4,200 is the negative value we got. We got the negative value as the net present value at 12%. So we are calculated, we have the net present value at 12%. We have the net present value at 10%. Right. So we can apply to the equation. Lower discounting rate. Discounting rate we have 10% we have 12%. So the lower one is 10%. So we take 10% ARR is equal to, the lower rate is 10% plus net present value at lower discount rate. Net present value 10%, lower discount rate is 10%, net present value is 9,900. So that is 9,900 multiply the discount rate, higher discount rate minus lower discount rate, that is 12% minus 10% divided by net present value at lower discount rate plus net present value at higher discount rate. Net present value at lower discount rate is 9,900. Then here 4,200. Here you no need to consider that is minus figure or positive figure. You have to just write the amount. Okay, be careful. So the lower discount rate is 9,000 plus 9,900 plus 4,200. 4,200 is equal to 10% plus 9,900 into 2 is equal to 19,800. 9,900 multiply 2 divided by 14,100 is equal to 19,000. That is 10 plus 19,800 divided by 14,400 is equal to 10 plus 1.40 is equal to, what is the answer? 11.40%. Done. Next, you need to consider, that is the net present value at lower factor and the higher factor is positive or negative. You have to just take the figure. Okay. So next we can move to the B part. We are done the 2A completely, we are done. So next we will move to the B part. Advise the directors whether Z Limited should purchase the machine to manufacture the new product. The manufacturing price and everything we are calculated now. Payback period, internal rate of return, average rate of return and net present value. So now they are asking, advise them, they should purchase the machine or no. Justify your answer with reference to financial and non-financial factors. So children, when you are writing the answer, you have to clearly write financial and non-financial factors. So first you check what is the total mark. Total mark is given 7 mark is the total. So we have 3 mark for financial factor, 3 mark for non-financial factor and 1 mark for the decision what suggestion you are giving to the. So financial factor, first we can write the financial factor. Financial factor. First one, financial factor is the first one. The investment has a positive net present value. 9,900, right? The investment has positive net present value. Because the company decided to take cost of capital 10%. That amount was positive net present value. That is how much? 9,900. Then the payback period or internal rate of return and ARR. The IRR, the internal rate of return, that is 11.40%, higher than the cost of capital 10%. They will get more IRR than the cost of capital, that is 10%. Next, ARR also higher than the cost of capital, right? So the third one, ARR. What was the ARR? Already calculated, average rate of return 16.67%, higher than the cost of capital 10%. So financial factor, 3 points we are written the financial factor. Okay, next we have to write the non-financial factor. What are the non-financial factor here? This all are affecting the money. The next one, non-financial factor. Here the question they are clearly saying, that means they need 300,000 is the amount and everything. Then some points they are given. They have to find a specialized engineer. So then they have to purchase direct material from a new supplier if they are producing. For this customer, they have to buy the materials from a new supplier and they have to hire a specialized, the expert engineer. So the non-financial factor. What are the non-financial factor? The first one, staff training required. Staff training. Because they are buying the new machinery, staff need the training. The second one, reliability of raw material, because they are buying from the new supplier. So reliability, they are not purchasing from the existing supplier, they are buying from the new supplier. So reliability of raw material, supply from new supplier. Supply from new supplier. Next, the third one. What is the third one? Availability of the expert engineer. So availability of qualified and specialized engineer. Availability of qualified specialized engineer. Now you are written financial factor and non-financial factor. The next thing you have to advise them. You can advise buy or not buy. That is completely up to you. So it should be compared to the answer. So here I recommend they should purchase. If you want, you can do. What is your response? You can ask them to buy or not buy. Okay, but your answer should be compared or matching with your explanation. So here I am saying Z Limited should purchase the machine to manufacture the new product. Machine to manufacture the new product because as they have high net present value, because they have high net present value, IRR, ARR. So they have more, these are the then. So they should accept the, they should not accept, they should buy the machine. So the next part, hope you are clear. So minimum 3 financial factor, 3 non-financial factor, then 1 mark for the advice. Next, the next part, the expected cost of the machine 300,000. That is the price, right? Includes an import duty 20%. So the cost was the expected cost of this machine is 300,000 is the cost 20%. But the import duty has increased 30%. That has increased 30% due to recent unfavorable trade agreement. Now the cost is again increasing. Explain the impact of this increase in the import duty on the decision B. So decision B, already we requested them, you should buy, you should go with the machine. But now how the 30% import duty will affect them? So support your answer with calculation. They want us, when we are giving the explanation, they want the calculation from us. So we have to check what changes this 30% will make in the our B answer. The new cost of machine will be more. Before it was, what was the cost before? That is, if the cost is 100% and import duty is 20%. So before it was 120%. Now it become 130%. Instead of 20, this become 30%. So the new cost will be 130%. So the increase in cost, the first new cost of the machine will be increased. The increase in cost, the increase in cost will be how much? Before it was 300,000 divided by 120%. Now this is becoming 130%. It became 325. So that is, now it became 325, means the increase is 325 minus 300,000 is equal to 25,000 is the increase. 25,000 will be increasing. Now, next, payback period. Now the cost will be increased. So payback period, accounting rate of return, net present value, each one, because they are asking us to show the calculation. So each one how it affect. Next one, cost we are done. Cost part we are done. Next we have payback period. Payback period. Payback period will be, because before it was 325 minus the payback period. You know the equation of the payback period. Like, the cost before recover and now the unrecovered cost mean and next year. So here that will become 325 minus we have done here, how much it was? Yes, the payback period, the 3 years it will be 290,000. The payback period 60 plus 100,000, 130, then the cost will cover with 4 years. So the initial period, it will be 290,000 divided by the next year payback is, the next year net cash inflow is 110,000 plus, here 3 plus, the EA is 3 plus, into 365. That become 117 days. 300 plus 3 years plus 170 days. 117 days. So before it was 3 years. So what is the difference? 3 years 117 days. 117 days minus, before it was 3 years. How much it was? 3 years 34 days, right? So 83 days more. 83 more days to pay back. Payback is 83 more days. Next we can do the payback. We are done. Cost is 25,000 more. Payback is 83 more days to pay back. Next we have to find accounting rate of return or ARR. So ARR, what was the ARR? Was average profit divided by average investment into 100. The average profit before it was decreasing. How much? Before it was 300,000 only. Now we have the cost 325. So the profit was 400,000 minus 325,000 divided by 4. This is our average profit. This will become 18,750 and average investment 325,000 divided by 2 is equal to how much? 162,500 average investment and average profit. So ARR is equal to 18,750 divided by 162,500 into 100 is equal to 11.54. 11.54. Before how much was that? Before 11.54 is the ARR. Before it was ARR, before we calculated accounting rate of 16.67 was before. So now it is 11.54. 16.67 minus 11.54. That is 16.67 minus 11.54 percentage. So 16.67 minus 11.54, 5.13 declined. 5.13 has declined. Next, net present value. We have net present value. Net present value before, how much was our net present value? Was 9,900. Now we have to reduce the cost of the new item. What was the cost? The cost 25,000. Increased cost we have to deduct from the, because before we deducted only 300,000. Now it became 325,000 we have to deduct. So the extra 25,000 we have to deduct from the net present value. It become minus amount $15,100. So the net present value change from positive to negative. Net present value change from positive to negative. So we have checked each one with the calculation. The question asked us to check. So first one, the cost. The cost has increased 25,000. Next, the payback period. Payback period 83 days more. Payback period become 83 more days will take to get all the money back. So that also not good. Next we have ARR, average rate of return. Average rate of return has declined. 5.3% has declined. Then net present value. Net present value became from positive to negative. So what we will decide? That is good for the Z Limited? No. The increase import duty will affect the decision. So we write the increase in import duty, that is not good in any level like ARR, payback, net present value, everything it is affecting. Duty will affect the decision. We are changing the decision, right? We'll change the decision that Z Limited should not purchase the machine to manufacture the new product. They should not purchase the machine, that is not good for them, right? To manufacture the new product. What is the reason? Mainly due to a negative net present value. Mainly due to a negative net present value and affect cost, ARR and IRR also. So we are done. Now the paper 4, question number 2. Now we have solved the complete specimen paper of A-level accounting. Paper 1, paper 2, paper 3 and paper 4. So which paper you want next? Please send me the message in WhatsApp or put in the comment box. So I'll be solving that paper for you. Thank you. Thanks for watching. Before you are closing the video, please subscribe and support. Thank you.